Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us as we take a look at the first part in our year-long or our monthly series on the CME School of Futures. Today, we're going to be discussing an introduction to the markets. Now, the futures industry continues to attract significant interest with global market volatility, and as a result, many market participants are looking at the futures industry for risk management, trading, and portfolio diversification. I want to thank you for joining us today in our very first part of the series as we take a look at a comprehensive educational program that's designed to provide introductory information on key trading or key futures industry concepts. So with that brief introduction, I'd like to welcome Richard Jelenic, who is with the CME in their Education and Development Department. Now, Richard, I'm going to pass the ball over to you. If you'd simply unmute your phone, we'll go ahead and get underway. Welcome, Richard, and thank you for joining us.
Thank you for the introduction, Cynthia. And I would like to welcome everyone to the CME Group School of Futures in cooperation with Interactive Brokers. We're going to learn today about the futures industry, also known as the commodity markets. As Cynthia already referred to our markets as global markets, I will say good morning to some, good afternoon to others, as well as good evening to those in that zone. Today we're going to cover a variety of topics. At the introductory level, we want to start out with a history, which is not just going to look at the history, but how these markets actually developed from 1848 to where we are today. We're going to look at the economic functions of our marketplace. We'll talk about some of the terminology that is frequently used in our industry, and that information will be helpful for all the sessions throughout the year. And then the last part is a very important part of our industry, and that's the financial integrity, one of the key benefits of the futures industry. So let's get started here, going through a quick overview of the futures industry, starting out with CME Group. CME Group is a relatively new name in the industry. It has only been around since 2007, and that occurred with the merger between the Chicago Mercantile Exchange and the Chicago Board of Trade. Prior to the merger, the CME Group and the Chicago Board of Trade were the number 2 and 3 exchanges in the entire world. With that merger, we became the number 1 exchange. But that's not the important part. Shortly after that merger in 2007, we acquired the New York Mercantile Exchange, which also included the COMEX Exchange. These mergers of these exchanges to form the CME Group made us the most diversified of all exchanges, and we're going to look in a little while of all the different types of products that are available in our industry. Many of you, I would assume, have some background in the equity markets. So I always like to start out, because many people are not familiar with the commodity markets and often wonder, how important is the futures industry? How many people are affected by what happens in the commodity markets? So this is a question. The notional value of a whole year, an entire year of trading at the New York Stock Exchange, is equivalent to the notional value of 3 weeks of trading at CME Group. True or false? The answer is false. It's only 1 week of trading at CME Group. And again, not trying to sell the exchange or continue talking about the size, but just the emphasis of the importance of the CME Group on the entire globe. So let's get into the history of the futures markets. We're not going to go through every year, but I wanted to pull out a few years that were very important in our industry, especially with regards to CME Group and the exchanges that make up the CME Group. In 1848, the Board of Trade was the first modern era futures market with a constitution and principles that were established. At that time, there was 83 merchandisers that were involved in the exchange, in the creation of the exchange. Now, these gentlemen had tremendous foresight in that many of the rules, many of the principles that they put into act back in the 1800s are still applicable today. We'd like to promote ourselves, the exchange, as a global market. Well, actually, we became a global market back in 1855 when we had our first French government order for wheat coming into our exchange. Talk about change in history. That order took approximately 4 weeks to have it completed. Today, on our electronic trading platform, we are from the time an order is entered to the time it is completed is less than 5 milliseconds. So again, we continue to improve on the speed of trading. 1859, we received a charter from the state of Illinois, putting our marketplace under the preview of the state of Illinois. But through this charter, we were still granted self-regulatory authority. And this comes to the name SRO, Self-Regulatory Organization. All 4 components of CME Group, all 4 exchanges of CME Group, the Chicago Mercantile Exchange, the Chicago Board of Trade, the New York Mercantile Exchange, of which includes COMEX, we are all self-regulatory organizations. And this is going to change over time. 1865, about 17 years after the exchange opened, the exchange opened as a physical market, what we refer to as a cash market or an underlying market. For the first 17 years of the Board of Trade, that's basically what we were. The first futures contract came about in 1865, and we don't know the exact date because of a little fire that occurred in the city of Chicago back in those days, destroyed all the buildings and all the records. But basically, the first futures contract was an extension or an evolution of the contracts that we traded prior to then, known as forward contracts. So our history starts out as a spot market or a physical market. We then moved into a forward pricing contract known as the cash forward contracts. And every cash forward contract has certain elements. It has a quantity, it has a quality, a time of delivery, a place of delivery, and price. And forward contracts back then and today are fully negotiable between the 2 parties, the buyer and the seller of those contracts. After a while, there was a need to standardize the primary elements of the forward contract, and that was the quantity, quality, time, and place of delivery, leaving the only variable contract of these new forward pricing mechanisms known as futures. Price is the only variable. The other elements of a futures contract are standardized. And you're going to see how history tends to change over time. It evolves, but sometimes things go around and go back to where we started. We went from a market that was very flexible to a market that became very standardized. And then in recent years, the industry, the customers want more flexibility. And you'll see how the exchanges have adapted to the customer's needs, creating new types of contracts, adding the flexibility back into our markets. This in 1870 just shows the beginning of NYMEX. And if you look at the graphic, it's kind of interesting. It shows something that's very, the graphic might be a little old, but it represents the energy markets, the primary markets, the primary products out of NYMEX. But look at the first 2 graphics. The NYMEX exchange started as a butter and cheese exchange. The reason to point this out, the entire futures industry, regardless of the exchange that was created back in those days, was related to the agricultural markets. We didn't have the financial markets. We didn't have the equity futures markets until much later in the history. So NYMEX itself also started as an agricultural exchange. The Mercantile Exchange was originally called the Chicago Butter and Egg Board, again, eventually being called the Chicago Mercantile Exchange with a variety of products outside of agriculture. COMEX, again, agriculture, starting out with rubber, silk, and hide. COMEX eventually became known as the market for metals, precious metals, industrial metals. This is an interesting time. I jumped far forward. 1973, the Chicago Board Options Exchange opened. Now again, most of you probably have a background or a stronger background in the equity markets. Many people don't realize that stock options were actually created out of the futures industry. The exchanges looked at different products and continue today to look at new products to meet our customers' needs. And one area that we created in the futures industry at the Board of Trade was the stock option. Unfortunately, at that time, 1973, we had a relationship with our regulator at this time, the Commodity Futures Trading Commission, who was very interested in this new type of contract. It was only one specific product, but a whole new concept for the futures industry, and they thought it was a great idea. Also at that time, the SEC, the Securities Exchange Commission, who monitors the equity markets, said that stock options should be under their preview. So at that time, we had to continue to look at different ways that we could get this new contract out there, and as such, a separate exchange was opened, known as the Chicago Board Options Exchange. 1974, you see Commodity Futures Trading Commission, that was created. And it occurred earlier in history where they took the regulatory oversight powers away from the state of Illinois to the federal government. And then in 1974, they brought them under the Department of Agriculture and created this commission known as the Commodity Futures Trading Commission, which is still the authoritative power, government power, that oversees all the regulations of the futures industry. You can see that there's 5 CFTC commissioners. All of those commissioners are appointed by the President of the United States. Now here's a major change in history. We went from an open outcry, or sometimes referred to as an open auction marketplace, and we went to electronic trading. 1992, CME Globex was created. Many of the exchanges that started looking into electronic trading were first looking at developing a system that could accommodate after market hours. In other words, the evening hours. As even then we could see our markets becoming more and more global, and we were trying to make the markets more reachable by many other customers throughout the world. Globex, CME Globex, is the primary electronic trading platform. 2002, one of our exchanges, the New York Mercantile Exchange, saw an opportunity, again, going away from the traditional futures, the traditional options at that time, to get into the swap market. And they created a system, a platform, if you will, called Clearport, originally NYMEX Clearport. Today it's known as CME Clearport. And in very general terms, Clearport is an interface between the OTC space, where the majority of swaps are traded, and the futures industry. And it is a way of bringing the financial integrity of the futures industry into these OTC products. 2007, as I already mentioned, is when the actual merger between the CME and CBOT came together and formed the CME Group. NYMEX became a part, and by this time, by 2008, COMEX was already a part of NYMEX. And NYMEX now became a part of CME Group. So that's just a little bit of the history behind our markets. And a quick summary is our industry started as a cash market, also known as a physical market. And in today's terms, a lot of people refer to the cash or physical market as the underlying market. We quickly went from there into a forward market, a cash forward or a physical forward market. And because of the change of the market participants and the need for additional liquidity, certain market participants were looking for a different type of product. And that's where we went from the flexible or highly negotiable forward market into the standardized futures contract. Today in our industry, we trade futures, we trade options on futures, and now we're also entering into the OTC space with cleared OTC swaps. The next section that I would like to talk about are the economic functions. Why is this market growing so fast? Why is it so important to so many people throughout the world? Well, there's two basic economic functions of the futures market. The one that is most obvious and the one that affects the majority of people throughout the world, even people that never heard of the futures market, are impacted by what comes out of the futures market, and that's price discovery. There's a lot of misconceptions around price discovery. Many people think that the exchange itself sets prices. The exchange is not involved in the trading. We're a marketplace. We're a facility for buyers and sellers to come together and negotiate their transactions. The result being a price is being discovered. Now that price is very interesting. It may occur in one location, wherever that exchange is, physically on a trading floor, or more and more, as we'll see later, via the electronic trading platform. But this price is being discovered by a relatively few people, have an impact throughout the world on all people, whether they're directly trading or indirectly trading. And even those that are not trading the markets, one way or the other, are impacted by the changes in prices on a regular basis. The second economic function, and I would have to say, in my opinion, it is the most important economic function, used by a relatively few number, and that's called risk management. Risk management, a more common term in our industry, is hedging. This is where buyers who have risk that prices are going to go higher can use the futures markets to manage the risk of higher prices. Sellers on the other side of the market also have risk that the prices are going to drop. And they also can use the futures market to manage the risk of lower prices. So these are the two primary economic functions that continue to drive our industry, to continue to expand the volume in our markets. Another slide on the same topic, but I'd like to spend a little bit of time on it because it is a very important aspect of our markets. Price discovery. One of the greatest benefits of the futures industry is the transparency that we offer. Regardless of the size of positions that you take in a market, everyone has equal access to those transactions, to those bids, to the offers that are made. Price discovery is not only the ability to see a price, to see a benchmark price, or to see the fair value of a commodity, but to use that price throughout the world to create those underlying market contracts, also known as cash contracts or physical contracts. You've heard of a variety of different ones, from forward contracts to spot purchase or spot sale, delayed pricing, deferred pricing contracts, basis contracts, many of the OTC products that are out there, the swaps. A common element of all these underlying or physical market contracts is a link to the standardized or the benchmark futures industry. Price discovery, this last bullet is very important. Two-way price impact. It's not only the people that are buying and selling the futures contracts directly that are having an impact on a price. It is the buyers and sellers of commodities all over the world. Through their bids and their offers in their local markets, that information is conveyed into the futures industry in the form of bids and offers, if you prefer the economic terms, in the form of demand and supply information. That's what the futures industry needs, is this supply and demand information. And they take that information, and it's the interaction of the supply and demand information, the interaction of the bids and offers coming into the marketplace that discover the price. So the futures industry relies heavily on the underlying market, on the cash market, to go about their daily business of discovering price. Now, once the price is discovered, who is the recipient of that information? It is the same place, the same participants that provided the initial information for price discovery. They're now going to use that discovery process, that price that came out of the discovery process, for their own needs in their own parts of the world. Risk management. Hedgers are going to use the futures industry products and services to either reduce or in some cases eliminate the market risk. Where's the market risk that they have? It's in their local markets throughout the world. Using a futures product, they can help eliminate the risk no matter where they're located. Now there's also another part, and we're going to talk about this in the next session during February, about the different participants in much more detail. But for now, you need to know, beside the hedgers, there's also speculators that are involved in the markets. Now they're in the markets at the same time. They have extremely important functions that they provide, but they use the futures industry products and services to assume risk. Because what comes with the assumption of risk is the potential or the opportunity for profit. Another graphic, just a basic economics 101 session on supply and demand. Many of you may have taken an economic course and wondered, would you ever actually see a supply and demand curve in action, in real life? And all you need to do is come and visit one of the trading floors, and you could see a supply and demand graph in action. The futures industry is probably the closest form of the often elusive perfect competition. You may have studied that in some of your marketing courses with the different types of marketing systems, the perfect or pure competition. And you may have remembered the elements or the description of perfect competition: a homogeneous product, i.e., the words we already used, standardized contract specifications, large groups of buyers and sellers. These are global participants, tremendous amount of buyers and sellers competing with each other for these products. Limited barriers of entry or exit, very little government intervention in the market activity. Prices are determined, prices are discovered through supply and demand. So let's take a look at some of the markets, again, as an overview. Futures markets located relatively in one location, this in terms of the physical trading floor. But with the addition of electronic trading, our markets have a reach throughout the world. And many people will refer to these markets, the futures markets, as a global benchmark. Types of futures market contracts, I mentioned some of these already. The futures contracts, we have them traded here as well as being cleared. Cleared simply meaning at this point in our discussion as the financial integrity. The options contracts, both traded and cleared. We have cleared only OTC swaps. And the swap area, the OTC swap area, is an area that we consider to be a growth area. And you will see some changes in that in the near future. Some of our contracts require the actual or the physical delivery of that commodity as settlement for those futures contracts. Others have what we refer to as a financial settlement, or sometimes known as cash-settled futures contracts. Type of product complexes, virtually everything, with the merger of all the exchanges to form the CME group. As I mentioned earlier, We are one of the most diversified exchanges in the world. Here's a list of some of the commodity product complexes that we have, and we're going to learn about these throughout the year. The commodity area, interest rates, the FX markets or foreign exchange, the equity index area, alternative investments, the energy markets, and the metals. And again, we'll have sessions on each of those to give you more information, detailed information, about how those markets behave and the type of market participants that are interested and use those products on a regular basis. So let's get into a futures contract here. What is a futures contract? On the left side box, you can see a basic definition, which we'll go through shortly. And on the right hand, we have some questions, hopefully to bring out a little more color to these futures contracts. What are they? How do they behave? Who's involved in them? A futures contract is a legally binding agreement to accept delivery or to make delivery of a standardized, there's that word we mentioned earlier during the history, a standardized quantity, standardized quality of a commodity to a standardized place in a standardized time period for a price discovered in an organized futures exchange. In short, a futures contract is an agreement between a buyer and a seller that they agree on a price today that is good for the delivery of the underlying product at some time in the future, hence the word a futures contract. Now, some of these questions, if you're very new to futures, could be a little misleading at first, so we're going to try to clear up a few things. These are legally binding agreements to accept delivery or to make delivery. Accept delivery if you're a buyer, make delivery if you're a seller of futures contract. Now this first question, how many contracts result in physical delivery? If you go to the definition, you might say, well, 100%. It says it's a legally binding agreement to accept or make delivery. Well, in fact, delivery is not a primary function of the futures market. Some markets, for example, the agricultural markets, less than 2% of all trading volume in the agricultural contracts will ever result in physical delivery of that agricultural product. Other complexes will be right around that 2%, some slightly more. But for all complexes, again, the primary function of the futures industry is not the actual physical delivery. It is risk management, that economic function we talked about. Using the futures industry products, whether it be a futures, an option, or a swap, to manage the risk of the physical product, of the physical transaction that is going to take place at some time in the future. Is it a good idea for a buyer to take delivery on a futures contract? Regardless of the complex, regardless of the product, it is not economically feasible for a buyer of a futures contract to take delivery on the futures contract. Economically speaking, financially speaking, the buyer is better off taking physical delivery in their local cash markets. In the futures market, it is the seller who is going to initiate delivery, and it is the seller who is the driver of all elements of the delivery process. Do futures contracts replace cash contracts? Absolutely not. They complement or supplement cash contracts or cash transactions. The futures contracts are there as price insurance for the eventual cash contract or the eventual cash transaction, which is the only variable component of a futures contract. We talked about this a little bit, comparing forward contracts to futures, as well as this definition on the left side. The variable component of a futures contract is price. let's get back briefly to delivery. Why is delivery requirement on a futures contract so important then? If I'm accurate in saying that very few contracts ever result in delivery, why is that delivery element a part of every futures contract? Why is for lack of a better word, the threat of delivery on a futures contract there? It is there for one reason, and that is to keep a very strong relation, in other words, correlation, between the prices in the cash market and the price that's being discovered in the futures market. By having this strong correlation, and correlation we're meaning the markets are moving up and down together, not necessarily by the same amount, but in the same direction. This strong correlation is what allows the primary economic function of our market, risk management or hedging, to work. Is there only one contract size available? For some commodities that are traded in the industry, yes. But for some of our products, we have a couple different sizes. Some of the equity index contracts have the full-size contract and they have the mini. Some of our agricultural products have a full-size contract and they also have a mini. Just the size of the contract is different. Are sellers required to deliver a specific quality? Yes, the specific qualities are in the rule books. There is a benchmark or standardized quality attached to every futures contract, but when you look at the details of those contracts in the rule books, you'll see that other qualities are acceptable for delivery, either at a premium or at a discount to that standardized quality. What is the ADV? ADV, average daily volume, for the key agricultural products. Let's take a look at a couple of other products, not just agriculture, because we're trying to expose you to the variety of complexes that are available. Corn, an average daily volume for corn, about 420,000 contracts a day. That's combining corn futures and corn options. Corn futures alone, 310,000 contracts a day. Each of those contracts is 5,000 bushels. Crude oil, 820,000 contracts a day. Eurodollars, 2.9 million contracts, average daily volume. Each one of those Eurodollar contracts, interest rate contracts, are $1 million contracts. The mini S&P 500, 1.8 million of these futures are traded. So again, significant volume. The last one's interesting, and at first glance it may appear to focus simply on the agriculture, but we'll change it. Does this match up with the underlying markets? Does the volume in futures match up with the volume in the physical markets, in the cash markets, in the underlying markets? And the answer is no. The volume in the futures industry is considerably greater than the volume in the underlying markets, and that's because the number of participants in the underlying market that have risk associated with the same product is much greater. As such, the use of futures by many people, many times the volume that is actually in the underlying market. And again, that varies by complex. When I'm giving a presentation like this, I'm making a lot of general comments. Every industry is unique. So as we touch on different complexes throughout the year, we'll give more specific information on how those markets react. The futures contract, the basic definition, again, just the ability to lock in a price for a futures delivery. A couple of contract specs. We refer to these as salient features. Again, for the full, detailed detailed contract specifications, you'll have to go to our website under the resource section and look at the rule books for each of those exchanges where these products are traded. The E-mini S&P 500 futures. It's a $50 multiplier compared to the full size of 250. So one-fifth the size of the full S&P contract. Every commodity has a pricing unit, an index point. In other words, if the S&P goes from 1300 to 1301, that's an index point. That's $50 change in the futures price. The minimum amount that a contract can change price in the case of a E-mini is 25 index points, or $12.50 per contract. The ticker symbol, this product is traded electronic only, and that's something, every commodity will be different. Some are traded on the floor, some are traded electronically, some are traded on both platforms. If they're traded on both platforms, they'll have two different ticker symbols representing both Globex as well as the open outcry or open auction. There's daily price limits. Most commodities that are traded in the futures industry have limits on how much the market can change. In the case of the equities, most of these limits are downside limits only. Many of the other commodities that are traded in the futures industry have limits up and down. Contract months. Every different product has different months. The indexes are traded in the quarters, March, June, Sep, and Dec, with the acronyms representing those months, H for March, M for June, U for September, and C for December. This is one of those products that is cash settled. Again, as we mentioned earlier, some products are physically delivery. Trading hours. Again, being global markets, every product has different hours to meet their customer needs. Electronic for the E-mini from 5 o'clock at night to 3:15. There's a 15-minute halt there until 3:30, and then they continue to trade for another hour to 4:30. At 4:30, there is a half-hour break. So technically, a Monday in the United States, the trading day actually starts on Sunday evening with the 5 o'clock electronic session. As I'm going through this rather quickly, I would like to clarify one point. On the tick size, I believe I said it's 25 index points. That's not 25 full index points. That is a quarter, 1/4 of an index point. The index point is $50. The minimum price fluctuation is a 1/4 of a point, or $12.50 per contract. We won't go through this one very quick, but we have it in the presentation just to show you a product that is also physical delivery rather than financial settlement. It has daily price limits. A normal daily price limit in corn is 40 cents per bushel, and that limit is related to the previous day's settlement price. For example, if corn settled at $6 per bushel yesterday, today there is a potential range of $6.40 on the high end and $5.60 on the low end. Again, opposite of what we already discussed about the equities, where their limits are only on the downside. Most commodities have limits both on the upside as well as the downside. And again, different set of hours compared to the equity markets. And those hours are also different than the financials. So let's get into some futures terminology here. Very unique set of terminology. Things like longs and shorts, bulls and bears, ticks, pits, a variety of different language that's used in our industry. So let's try to make a little sense of some of these terms. Spot market, we already touched on. That's the physical market, that's the underlying market. Unlimited number of these markets throughout the world. Anywhere where a buyer and seller get together. exchange money for a physical product is the underlying market. It's the physical market. It's the spot market. Basis is something very important when we get into risk management. We talked about correlation, that futures prices and cash prices move up and down together, but not necessarily by the same amount of money. Basis is the relationship between a cash price anywhere in the world and that benchmark futures price. Cash prices all over the world are different, but the one constant is that standardized futures price. So the relationship between a cash price anywhere in the world and the futures price is known as basis. Market price, basic term, but many people often don't understand it. A market price, or the market, is not one price. A market, if you ask somebody for the price of November soybeans, they should not give you one price. You should be getting two prices. You should get a bid and you should get an offer. A bid is an expression to buy, an offer is an expression to sell. When you add into the fact that we have two different trading platforms, both the trading floor and Globex, when you ask somebody for the price of November soybeans, they should be giving you four numbers: the bid and the offer from the trading floor and the bid and the offer from Globex. However, keep in mind, at all times, it is you, the customer, that makes the decision on which trading platform, whether it's the floor or the Globex electronic platform, that you want to have that trade placed. Also keep in mind, while we're talking about bids and offers, a bid and offer is always there for our customers. If you come into the market and sell, yes, you might want to sell at the offer, the higher of the two. But in reality, if you come into the market and have to sell, right now, you're going to sell where someone is willing to buy. In other words, you're going to sell at the bid. Conversely, if you come into the market to buy, you're going to buy at the price that someone is willing to sell. You're going to buy at the offer. And so it's very important to have a market that is very liquid, where the pricing is very efficient. What do I mean by efficient? I'm talking about a market where the bid and the offer are as close together as possible. And we see that all the time with the tremendous amount of trading volume and open interest in our markets, that many situations you will see where the bid and the offer are the minimum allowable difference in price. In other words, the difference between the bid and offer in many cases is the tick size of that particular contract. Long and short, these are terms to reflect buying and selling positions. If your initial position is to buy a futures contract, you can say that you went long, that you have a long position. Having a long position, using the definition of futures, is a legally binding obligation that says you will accept delivery of the futures of that commodity at some time in the future. If you are short, if you initially go into the market and sell a futures contract, you went short. You have a short position, you have a short obligation, which says you have an obligation, a legally binding obligation to make delivery at some time in the future. We talked about delivery and we said very few contracts ever result in delivery. What happens to all of those legally binding agreements to accept delivery or make delivery? Before the contracts expire, the longs will sell back their contract. The shorts will buy back their contract. Taking the opposite position to your initial position in the futures market is referred to as offset. And that is where the great majority of futures and option transactions, that is what happens to the majority of them. We talked enough about delivery. We've mentioned the tick size. That's the minimum price fluctuation of a futures contract. In other words, In a corn contract, the minimum price fluctuation is 1/4 cent. You cannot trade futures in 1/8 cent. Spread. This is a big part of our industry. We're going to touch on that in our next session in February, and then in each of the product sessions throughout the year, we'll talk about spreading. For today, it is simply, in the most basic sense, the purchase of one contract and the sale of another. This is contrary to just going long or short. Long or short are what we refer to as outright positions. If you are long and the market goes up, you will have a profit on that transaction. If you're short and the markets go down, you will have a profit. When you're putting on a spread, it's not outright positions. You're looking at changes in the relationship between two or more contracts. And that relationship can improve to the level that you're expecting regardless of the market going up or the market going down. Now we're dealing with a relationship known as a spread. Speculation, we touched on that. It's simply the assumption of risk. Speculators do not have an interest or a position in the underlying market. Bull and bear. Bull and bear are terms used to describe individual traders, to describe markets, to describe market trends, or to describe strategies. Anything with the word bull in it or bullish is in reference to the markets going higher. A bull strategy is a strategy that will profit if the market is going higher. Bear, on the other hand, is a reflection of the markets going lower. Margin. Margin is similar to a term you hear in the equity market in terms of how it's spelled and how it's pronounced. But that's the extent of the similarities. It is a completely different concept than stock margin or buying stock on margin. Margin in the futures industry, some exchanges actually refer to it as a performance bond. It is money that is put up by both the buyer and seller of futures contracts because they both have obligations to perform. And by having this capital in their trading accounts known as margin, this is the financial integrity behind the futures contracts. Commission, that is no different than what you've already encountered in the equity markets. It's the amount of money that you're going to pay the broker to execute that transaction. Volume and open interest, like any market, volume is the number of trades that take place, number of contracts, not the number of trades. Trade could include multiple contracts. The number of contracts that trade in a given time period. Most common volume that you'll see, tables, charts, are in reference to daily volume. But there are other charts, weekly, monthly, yearly volume as well. Average daily volume, as I quoted earlier. Open interest. Open interest is a reflection of the efficiency of a market. It's a reflection of the market liquidity, the number of buyers and sellers that are involved in that product. Open interest at any time is the number of contracts that have traded to that point but have not been closed out either through delivery or offset. Obviously, the greater the open interest, the greater the market efficiency, the greater the liquidity, the tighter the bid-offer spread. Generally speaking, and again, when I say general, it could vary by complexes. Generally speaking, the greatest open interest, the greatest volume in the futures industry is usually in the contract month that is closest to the current time period. We have CME group platforms here. I want to go through this quickly. I want to make sure we get to our financial integrity section. We already touched on the different platforms. We have the open auction. We have the open outcry. We have 3 trading floors. 2 are here in Chicago. 1 is in New York. When it comes to the trading of futures, the great majority of futures contracts are not on the floor anymore. they are primarily on the Globex, the electronic trading platform. However, when you take a look at commodity options, the majority of commodity options, and this goes across all complexes, are still on the trading floor. We have added technology to the floor because time is money. Things such as creating an electronic clerk, removing the human element of moving an order from the trading desk into the pits. Now we have an electronic system in place. Many of the traders, because of the balance and the shift in balance of volume between the trading floor and the electronic, there are traders on the floor that are going to be involved in electronic trading as well, either with a tablet strapped around their neck or a handheld, being able to have access to the Globex platform. CME Globex, it's the premier electronic platform. All products from all of our exchanges are on CME Globex. We even have some other exchanges. As technology is very expensive, other exchanges have elected to use our electronic platform, CME Globex. Again, both trading of futures and options. The majority of futures are on Globex. Global distribution. Regardless of where you're located, you should have access to CME Globex. CME Clearport, again, we're going to save this for another time. Basically, this is what came out of NYMEX. They created the Clearport system. In short, it is an interface between the OTC space, where the majority of swaps are traded, and the futures industry, primarily the financial integrity of the futures industry. So our last section here is the financial integrity. Let's take a quick look at this because it is a key benefit of the futures industry. Market integrity, market regulation. We talked about how we went from a state regulatory organization where the government of the state of Illinois oversaw all the regulations in our industry. That shifted to the Commodity Exchange Authority, and then eventually in the 1970s to the Commodity Futures Trading Commission. Again, all four exchanges, even though we are referred to as CME Group, kind of an umbrella corporation consisting of individual SROs, CME, CBOT, NYMEX, and COMEX. We have a department known as Legal and Market Regulation that are responsible internally for the regulation of our markets. Externally, as we mentioned, Commodity Futures Trading Commission and NFA, National Futures Association, was created to protect all customers of the futures industry. On the bottom, you note that I have a statement there. The Dodd-Frank bill was passed in July of 2010. They're still working on this, but it's taking a look at reviewing, revising regulation of all markets, not only futures and equities and options, but also the OTC markets are being looked at. So you're going to hear a lot more about the Dodd-Frank in the coming days, weeks, and months. Financial integrity. CME Clearing Services. We are considered the buyer to every seller and the seller to every buyer. Because unlike most markets that the average human being gets involved with, the average buyer knows who the seller is. The average seller knows who the buyer is. In the futures industry, you're getting involved with buying and selling legally binding contracts, but you actually never know who is on the other side of the market. Just because you're a hedger, you're not sure if it's a speculator or another hedger on the other side of the market. But most importantly, it doesn't matter. CME Clearing is in between every transaction, as the buyer to every seller and the seller to every buyer. CME Clearing gets involved on a daily basis, and we call this system a mark-to-market system. Every day, every person that has an open position in the futures market, their accounts, their margin accounts or their performance accounts are going to be adjusted to reflect that day's settlement price, adjusted in terms of receiving credits or receiving a debit to their daily account. They do this through monitoring of margin. CME Clearing gets involved in the delivery process for those contracts with regards to delivery, matching up the buyer and seller, the long and the short. They get involved in facilitate the option exercise process between the buyer that exercises an option and the assignment to a specific seller of that option. They also get involved in the clearing of the OTC products that go through Clearport. The model we have in the futures industry is what we refer to as a central counterparty. Again, CME Clearing is the buyer to every seller, the seller to every buyer, as opposed to a bilateral model, in which case the only one protecting a buyer is a specific seller. The only one who's protecting a seller in a contract is the specific buyer on the other side of the transaction. The CME Clearing process. We have this pyramid here, basically trying to show that regardless of who you are, whether you have a member's trading rights, whether you're an outside customer, whether you're a broker, regardless of the type of trader, regardless of the size of trader that you are, anyone who has a position in the futures market has to have a margin account, a performance bond account, to ensure the integrity of these markets. You could see in this CME Clearing process, the daily settlement process, we call that a zero debt or no debt system, where all the losses are collected, all the debits come into CME Clearing, and they are paid out to those on the receiving end, to those that are receiving the credits. This again is done, I highlight, a daily process. Futures margin, it's a performance bond. It's required of anyone that has an obligation. It's required of the buyer and the seller of futures, because regardless of being a buyer or seller, both have obligations to the marketplace, not to an individual, but to the marketplace. As such, a margin requirement is in place to ensure the integrity of those products. In the option market, commodity options, we're jumping a little ahead there, only the seller of an option has an obligation to fulfill rights. As such, the seller of an option also has margin requirements. Note a slight difference here in margin, futures margin versus equity margin. It's not a down payment. It's not like you're buying stock on margin. You can't buy a commodity as a down payment. This margin is a performance bond. It is not a down payment when looking at futures margin. It's usually quoted in dollars per contract. When you go to our website, there's a section called Clearing, and you'll see all the performance bonds listed, depending on whether you're a speculator or a hedger. They have different levels. They're quoted in dollars, but if you know the size of their contract, it can easily be broken down into the unit size of the contract. Margin amounts vary by commodity, and what really is going to be looked at by CME Clearing to determine margin levels is the price level at a given time and the volatility. All other things being equal, you could tell I'm an economist, I like to use that phrase, all other things being equal, the greater the price level, the greater the value of the contract, therefore the greater the amount of performance bond or margin that is needed to ensure the financial integrity of that product. The other factor, market volatility. Again, all other things being equal. If you're in a market environment where the volatility is tremendous, the margin requirement is going to be much greater than when the markets are relatively flat. Using margin to trade futures adds a lot of leverage to your portfolio, to your position. Because think of it this way, margin is roughly 5 to 15% as a ballpark range. When trading futures, you can have control of a contract of much greater value by posting roughly 5 to 15%. Two types of margins. As a speculator, speculators have two levels. It's the initial amount is the money that is required per contract. Remember that. It is a per contract concept to initiate a futures position, long or short. And then there's a little bit of a buffer zone between the initial margin level and the maintenance margin level. Once your equity in your performance account, in your margin account, falls below the maintenance level, you will get the infamous margin call, which requires you to bring your equity in your account not back to the maintenance level, but all the way back to the initial margin level. So again, once your equity in your margin account falls below the maintenance level, you will get a margin call asking for additional funds, additional resources to bring your equity all the way back to the initial margin level. Here's an example of some of the margin requirements, the initial and the maintenance. Note, right next to the word maintenance is hedge. Technically speaking, if you're a hedger, you're involved in the physical markets. You're either going to buy or sell the physical product, the actual product. So they look at that hedge position as relatively less risk than someone who is speculating, who does not have that physical market position. Hedgers only have one margin level, and that is the lower of the two, the maintenance level. They always have to maintain at least that amount. Let's go through a quick example. In this example, crude oil, the margin requirements per contract, $7,560. It's a 1,000-barrel contract, so $7.56 a barrel. Maintenance is $5,600 per contract, or $5.60 a barrel. In this example, we're going to assume that on day one, earlier in the day, the buyer and seller entered into a futures contract at $100.50 a barrel. At the end of the day, the market settled at $100.50. Settlement price is determined by the closing market activity, either a closing price or an average of the closing range. And again, every product complex has different ways of determining the settlement. But the market settled at the same price that the buyer and seller entered into the account. On the far left side of the buyer's account, you see the amount of money he put in his account, and the balance at the end of day one was the same. Note, margin is not a cost. The absolute amount of money you put in your margin account is not a cost. It is your money that is being kept in a segregated account. The minimum amount required is in the segregated account. And at the end of day one, you can see their equity, their balance, is the full amount because the market has not changed. Likewise, on the seller's account, they put in $75.60. At the end of day one, it's $75.60. And please make a note, there's a slight typo there. That should be $7,560, not $7.56. The next day, the market changes. The market moved higher in favor of the buyer. It moved in favor by 50 cents a barrel, which is $500 on the 1,000-barrel contract. Nothing changed in how much they deposited, but look at the equity. The buyer's equity went up by $500. Where did it come from? Well, it came directly from CME clearing, but indirectly it came from the seller. And look what happened to their balance. It went from $75.60 to $7,060. But look at their balances, their equity. Both are above the maintenance level, so they can continue to trade another day, meaning there's sufficient funds. Even though the market price has changed, there's sufficient funds in both the buyer's account and the seller's account to continue trading for another day. Now, the next day, the market moved $2 full per barrel, $2,000 move. And you can see that increase in the equity of the buyer from $8,060 to $10,060. Again, where did that $2,000 come from? It came from the account of the seller. Now, look at this. The equity in the seller's account fell below the maintenance level by $540. It doesn't matter how much it fell below. Once it falls below this $5,600, you will get a margin call. In this example, we have to bring the equity back from the $5,060 all the way to the initial level of $7,560. To do that, they will get a margin call for an additional $2,500. You can combine that $2,500 with the original $7,560. That gives a total deposit from the seller into their margin account of $10,060, of which on day 3 they're now entitled to, or they have equity in, $7,560. Again, after day 3, after the margin call was made by the seller, both the buyer and the seller can continue to trade another day. Now on day 4, the market came down by $1, $1,000. You can see that in the decline in equity of the buyer and an increase in the equity of the seller's margin account by the $1,000. They can continue to trade. If they closed out their position at 102, the seller would get $8,560, and the buyer would not only get their original margin that they deposited, but the gain on their transaction of $1,500. So a little bit on margin. This happens every day for anyone that has an open position in the futures market, and this is the financial integrity of the futures industry. Trading on margin, I don't want to go through an example. You could take a look at it quickly, but obviously having control of a larger contract, a larger value contract, by only putting up a relatively small amount of money, that's what we refer to as leverage. With soybeans trading at $12 a bushel, it's 5,000 bushels. That's a $60,000 contract. But in this account, as a speculator, all you would have to put up into your margin account is $33.75. When the market changed by 10 cents, that's $500 per contract. That $500 on the margin deposit gives you a close to 15% return. If you had a $500 profit, but you had to put up $60,000 total value of that contract, look at the return there, considerably less. Again, trading with margin gives you as a speculator a tremendous amount of market leverage. I gave you an example where it shows the benefits, but keep in mind, market leverage could easily work against you. So last but not least, CME Group's benefits. We have a variety of products. We're not only the most active exchange, but we are the most diversified exchange. Whether you're a hedger, whether you're a speculator. The flexible uses, risk management strategies, speculative strategies, and all of our prices that are discovered in our markets are the foundation for what happens in the cash market, the underlying markets. Liquidity and transparency. If you look on CME Globex, you get the information from the trading floor. Any market participant wants information, and that's what we pride ourselves in, providing a tremendous amount of liquidity in terms of efficiency of our prices, as well as the transparency. We talked about the regulation today and the financial integrity with margin. In customer choice, I can't think of any market that has the amount of choice for customers using our facilities as a trading or investment operation. You have the electronic platform, you have the trading floor, and now we have this relatively new system known as CME Clearport for OTC products. With that, I am going to close with just a couple of comments. We have a tremendous amount of educational resources at cmegroup.com/edu or /edu. Make sure you go there. We have a lot of simulations, a lot of literature, a list of webinars, a variety of different things. The School of Futures was created by the CME Group. The full program is a 5-day program that we offer once a year in Chicago and New York. It is a 5-day program, 8 hours a day. It's a 40-hour course. This year we're going to have the program conducted in New York at the NYMEX facilities, June 25 to June 29th, Monday through Friday. And then we will be in Chicago from July 16th to July 20th. Go to our website under the Education tab, and you'll see some information on this opportunity as well. Thank you for participating in today's webinar. I'll be happy to take some questions.
Oh, excellent. Thank you so much, Richard. And I do want to invite some questions and give Richard a chance to see what it is, those questions that are coming in. And while we're doing that, I do want to take a quick pause and let Richard catch his breath here to do a quick poll. Now, IB's management does ask that I do this poll in every single event, so you'll see that I've just opened the window up. There are 3 short questions there, and I do ask your help in making your selections. A couple of those questions are multiple choice. If you'd make your selection and then click the Submit button. Now, you will find that question number 2 is an input field, and we do welcome any comments or suggestions on other topics or items that you'd like to see covered in the webinars. So if you write it there, I actually do review with management on a weekly basis. Okay, poll has just ended, so thank you very much, everyone. Very helpful with that. Now, you can all minimize or just remove that polling panel by using the Minimize button that's located to the right-hand side of that polling panel title bar. Also be aware there's a chat panel. If that chat panel has collapsed, you just need to double-click the title bar and it will expand so that you can send any questions you may have for either Richard on the products and the topics that he was talking about today, or I'd be happy to show you as well how you can access that information that he was discussing on Interactive Brokers Trader Workstation. Well, I see a couple of questions that have come in for you, Richard. Do you want to handle those?
Yes, I would. Can you hear that?
Yes, we can.
Okay, very good. Question from Matt to all participants. If you speculate and day trade, do you need a specific amount in your account? When you trade, margin is a requirement for both buyers and sellers of futures. It doesn't matter what type of trader, if you're a scalper who's in and out of the markets real quick, a day trader which try to go home every night as net even, or a position trader. They're going to look at the open positions in terms of margin. Now, this is a concept. We had that pyramid, and I didn't spend a lot of time on the pyramid. As an end user customer, your contact in the clearing system is going to be your broker. Your broker knows what the minimum margin requirements are needed. This is amount that goes in segregated account. But they can ask for additional funds beyond these exchange-stated minimum requirements. But basically, at the end of the day, yes, you have to have margin per contract. But if you're netting out even at the end of the day, there's nothing going to change in the amount of money that you had in your account, other than the credits, obviously, or debits that were made on the transactions. Margin is money that is required per contract. Are the margin requirements, another question, are the margin requirements the same for buying and for selling short? In our industry, selling short, or at least in my opinion, is redundant. When you sell a contract as your first position, you went short, or you shorted the contract. And for futures, there's no difference between buying or selling. Both parties have margin requirements. If you look at it this way, if you put a trade on at any given time, unless you have that crystal ball, no one knows if the markets are going to go higher or lower. Again, when you're trading futures, it's unlike many other markets where you know the opposite party. You don't know who's on the opposite side. As such, when you're buying, you're entering into a legally binding agreement to accept delivery with the entire marketplace. Conversely, when you're selling or going short, you're entering into a legally binding agreement to make delivery, not to an individual, but to the marketplace. And to ensure the integrity of the markets, long story here, the buyer and seller of futures both have margin requirements because they both have obligations to perform to the marketplace. Now, I'm going to add to that question, on the option side, when you buy an option, you're buying rights, but not obligations. When you buy an option, whether it's a call option or put option, I know I'm giving some terms some of you may not be familiar with, you are buying certain rights, market rights. You have the right to do something, either buy in the case of a call, sell in the case of a put, but you don't have obligations to buy. You don't have obligations to sell. You have rights. Because you have no obligations as a buyer of an option, buyers of options do not have margin requirements. Now, keep this in mind. If you're a buyer of an option and you exercise that option, you're going to get a position in the underlying futures market. So if you ever exercise an option, you're going to go from the option market into the futures, in which case you now have a futures position, which is an obligation, which means you will have a margin requirement immediately. Conversely, the other side of the option market, if you sell an option, you don't have rights. You're selling those rights. You're giving those option rights away. You have an obligation to perform. You have an obligation to fulfill those rights. Again, not to an individual, but to the marketplace. As such, the seller of options, margin requirements. Okay, let me see if there's some more questions here. Let me scroll down. Andrew, I'm looking at your question. What are the costs associated with rolling over futures to hold medium term, and are there any drawbacks? That is, when you say cost, I'm glad you brought that word up. I'm going to try to answer your question, but this is something you're going to be working with your individual broker in terms of the commissions. When you're rolling a position, you're taking a futures position. Let me make an example real quick. If you're long the March E-mini and you want to close that out before it gets close to expiration and roll it, if you're long the March, you're going to sell the March and then buy the next contract, the next quarter, which is June. Now, that is between you and the broker on the commission in terms of cost. With regards to the margin, you know, anytime you have that open position, you're going to have margin affiliated with it. And the reason I like that word cost, Andrew, and I appreciate it, it's something I omitted in my presentation. I said the absolute dollar amount of margin money is not a cost. It is your money that is being put into your account, your segregated account. It is not a cost, it's your money. But there is a cost associated with margin money, and that is interest. If you need to trade and you don't have the margin money and you have to borrow the money for your margin account, there's an interest fee that you have to pay on that loan. So that is a cost associated with margin. Or even if you have the money to go into your margin account, then you have the opportunity cost. Again, interest for not having that money be able to work for you. So again, the absolute amount of money that goes into a margin account is not a cost, but there are costs affiliated with that amount known as interest, either in terms of borrowing or the opportunity cost of not having it work for you. Now, we gave you a very quick overview of margin. There's a lot of information. There's different types of capital that are accepted by the exchange that could be put in initial margin. You could talk to your brokers. You could look on the website for a list of the different types of capital that can be used for margin. Mike, interested in the June seminar? That's great. I'm going to talk to our web people. At least some very basic information should be up there at this point. Again, in June, that's New York, June 25 to June 29th for the CME School of Futures. That's a 5-day, 40-hour program. The Chicago program is the 16th and 20th. Keep checking on our website. If it isn't there already, we're going to get it up very quick. Where are credit default swaps traded? I'm going to give you some general information. Go to our website under the interest rate, under the CME Clearport area, and you should see information on the credit default swaps. They may also be listed under the interest rate complex. Is there government oversight of our markets? Anything traded in our markets? Yes. Again, keep in mind, swaps are traded both in the OTC space, and we're starting to see swaps start trading in the futures industry. More and more of that's evolving as we speak. Not all swaps are traded in the futures industry. Majority of them are what we refer to as cleared only. In other words, they're still traded in the OTC space. They come to the exchange for clearing, but that is changing. Look to each of the complexes, look to each of the product complexes to get information. From Ina. Tony, real quick, I am not a trader. I have a little bit of experience. I've been in the futures industry for 31 years, always in an education role. My background is in agriculture. I have 2 degrees in agricultural economics. That's why you always hear my economic terms come out. I have worked with market participants for over 31 years. I would say the majority of my time has been with the hedgers, both on the sell side and the buy side. Majority of my work today is international, again with the hedgers, but I have developed a lot of materials, a lot of programs, talked with, worked with a lot on the speculative side of the markets as well. Your question, when you take a position, how long do you usually expect to hold it? Depending on the type of trader that you are, Tony, that'll determine how long. There's scalpers, that's a speculator that makes bids and offers, and they're in milliseconds, in and out of the market, very quick, usually large quantity, large number of contracts, and very quick period of time in the markets. Day traders, they like to go home net even. Position traders, someone that has a tremendous feeling for the direction of the market or a change in a spread, either from technical analysis or fundamental analysis, and so they're not worried about intraday or interweek, possibly not even intermonth movement in price. They have strong beliefs in that position that it came out of technical analysis or fundamental analysis, and they'll hold on to it with the belief that that trend is going to occur. I think that is it for today. Again, I want to thank Interactive Brokers for the opportunity to present to your customers. I truly enjoyed it. I will be back for a couple other sessions throughout the year, and I hope you plan on joining us at that time.
Well, Richard, thank you so much for the presentation today. And Richard is going to be joining us coming up in next month, February. We're actually going to be doing this entire School of Futures over the next 12 months on the fourth Thursday of each month. Now, what I do want to do is quickly show you where you can go and access the information. So notice your desktop is going to blank momentarily, and I did want to take you to the Interactive Broker site. Now notice I'm on the Education menu, and under Webinars, we do have two selections, one for live and upcoming webinars, as well as another section for previously recorded. Well, notice here is today's event, which we've just concluded. By the way, the webinar notes, if you missed the PDF copy, will be available on our website as well. Now I'm going to scroll down here because you'll see we already have the next session listed. So if you do want to register, simply click on this link. Now we do record all of these events, and we'll forward all registrants a hyperlink to the recorded playback. So if you have an interest, simply sign up and you'll get a direct link to the playback just as soon as it becomes available. Now also I did want to point out there is a previous webinars page, and I'm going to jump right over there because these events will all be listed under our industry sponsored tab. Now notice we do have some filtering criteria up at the top, and it will make it much easier for you to identify all of our School of Futures recordings by simply using the filter by our sponsor, which is the CME group. Notice here we include a direct link to the playback as well as a copy of the webinar notes so that you can access them as well. Now, I also want to mention, Richard brought up quite a bit of information, so let me quickly jump over into Trader Workstation. You'll notice here that I do have several of the CME product complexes already listed. I did want to show you that to add a ticker symbol, simply type that ticker in, click Tab or Enter, and then notice here that you'll need to locate the Globex futures and then simply choose your expiration date. I'll go ahead with 2012, and I'm going to select No here, and notice that it quickly populates within the window. Now, for those of you who are interested in the contract details, also notice that once you've added that ticker symbol, simply double-clicking on it opens up our description panel with the basic contract description listed here. You'll see notice here we have the underlying, the contract month, the multiplier. Here's even that symbol that you can add. Notice trading hours are included as well as the margin requirements. So there's quite a bit of information that's available here. You can access all of these ticker symbols if you do subscribe to IB's Securities and U.S. Securities and Commodities Bundle. So if you're already an IB client, simply open up. Notice here I do have a separate tab where I've entered all of these contracts that you may be interested in monitoring. By the way, they're also available in a paper account so that you can begin to practice trading and work in a simulated environment before you actually do start trading live. So let me take you back over just a quick look. I also want to mention coming up next week, we do have a real-time activity monitoring webinar that will be occurring. So if you do want more information about how to access or read your account screen, notice I'm going to open up the account window here, which will show your account balances, but also notice, as Richard was talking about today, there is a segregated commodities account for those margin requirements. So did want to point that out, but we'll be covering more on that in our real-time activity monitoring webinar coming up on January 31st, or available if you're listening to this with a recording. It is available on our pre-recorded sessions on the Interactive Broker website. So a quick look at what's coming up ahead, and I do want to thank both Richard and the CME group for their dedication to education. It's that which has made today's event possible. So please consider joining us next month on February 23rd as we go into further discussions in our School of Futures on market participants. Again, remember, fourth Thursday of every month. So thank you all, and thanks again to the CME. You can exit our event by simply using the X in the upper right-hand corner of the screen. Have a great afternoon, everyone. Thanks for your participation, and do remember to trade smart. Thanks, everybody.